Hello, and welcome to our webinar titled Smart Strategies for Retirement, where I'm going to share with you strategies for how to achieve a tax efficient and low risk retirement plan. I'll be your instructor. My name is Sean Polly, and I am a private wealth manager located here in Orlando, Florida. Actually, originally from this area, was born and raised in Winter Park. Graduated from the University of Florida, where I majored in finance, so I actually knew at a very early age that this is exactly what I wanted to do. And I've been doing this for the last approximately 27 years. I have been named a top wealth manager in Orlando, was also named a Best of Orlando financial consultant and a best financial advisor in Orlando. Fun fact about me, as a child, when I was 9 years old, I raced BMX bicycles and was actually ranked number 6 in the country. And on nights and weekends, you will usually find me out on a baseball field coaching my son's baseball team. He plays Little League Baseball and also travel baseball. And here's some pictures of him and his awards and trophies that he's won at several different tournaments. Also a picture of my beautiful wife and a picture of his Little League baseball team that I coached. So let's talk a little bit about what we're going to do today in the webinar. So I'm going to help you identify and understand your potential risks and help give you some solutions for how you can have a successful retirement. You will learn things like how to potentially make all of your Social Security tax-free, how to make your money more tax efficient and avoid higher taxes in retirement, how to create an income bucket strategy to weather almost any market. My promise to you is no product sales pitch. I'm not here to sell you any products. I want to educate you and help you to understand the important things that you're going to want to know and understand as you prepare for and go to and through retirement. There won't be any financial jargon. Well, maybe just a little, but I'll do my best to keep that to a minimum. And I'm going to hopefully share some strategies with you that you can actually implement on your own or with a financial professional if this isn't your kind of thing. Does this sound like you? Maybe you have no plan. You've got money that you've saved throughout your life. It's currently in your retirement account, your 401k, an IRA, maybe a 403b, and you haven't thought about how you're going to pull that money out in retirement to meet your obligations. Maybe you have a wrong plan. So you've been saving money and you're already retired and you haven't done anything to adjust your strategy, your investment strategy from what you were doing prior to your retirement. Maybe you're concerned about running out of money. This is actually the number one concern for people in retirement, is knowing, hey, what the cost of everything with inflation, cost of groceries, gasoline, healthcare going higher, am I going to have enough money to last throughout my life? And maybe you want to be efficient. You want to make sure that, hey, I'm not overpaying taxes. I've worked hard to save and accumulate this money, and I want to make sure that I'm not paying more taxes than I need to pay in my retirement. So why do I do this? I do this because I understand what it's like being you. There's lots of information out there. This is the information age. The challenge is, what's good information? There's many people out there that are, sharing different ideas, but we wonder, what's their objective? Are they looking to sell you some sort of a product? Are they really looking out for your best interest? Are they fiduciary who cares about you and your situation instead of, selling a product or generating some sort of a commission? And I understand because I know what they're pitching. And I know some of them are not doing what's in their clients, their investors, their retirees' best interest. They're looking out for what product might generate the best commission for them and not acting as a true fiduciary. And one bonus, I might show you how to have a tax efficient retirement and get your assets, possibly get all of your Social Security tax free. So my objective today is to help you insulate and quarantine your retirement plan by first helping you understand the major risks to your retirement plan, and then give you 3 simple tools or solutions that you can use at home or with a financial professional. The agenda will be, first we're going to talk about the risks in retirement, then Social Security strategies, income bucket planning, how to axe taxes, and then we'll go through some case studies. Number 1 risk, inflation. So you've certainly heard about this quite a bit over the last year. The price of gasoline, the price of eggs, the price of everything has been going up. Inflation has been at a 40-year high, so much higher than normal. Travel, another big risk possibly for retirees. Food and entertainment. You've got time now to go out and do more things, to eat out more. And of course, healthcare. As we all know, the rising cost of healthcare becomes more and more important for retirees because as we age, unfortunately, healthcare becomes a bigger part of our life. So let's take a look at that inflation risk and see what that looks like. So if you currently need $50,000 per year to meet your annual living expenses, and an inflation rate is at 3%. Now 3% is the historical average for inflation. Of course, like we said, it's much higher today, but historically the averages run about 3%. And if it were to run at 3%, that $50,000 that you need today would need to be $67,200 in 2 years, $90,300 in 20 years, and $121,300 in 30 years just to maintain your current lifestyle. And that's at 3%. So hopefully inflation doesn't stay high like it is, because with the current high inflation, obviously those numbers are going to grow that much faster. So what are interest rates at now? We know that interest rates have started to move a little higher than they have been for the last 10, 15 years. But bank accounts, CDs, where a lot of retirees will have a large chunk of their money, those aren't beating inflation. Matter of fact, they're not even keeping up with inflation. Interest rate risk. So this is another important risk that we want to be aware of. 66% of bond investors are not aware the value of existing bonds go down when interest rates go up. So there's actually an inverse relationship. And many are told as I move into retirement, I will purchase more bonds or have bonds as a larger and larger part of my portfolio. But it's important to understand how bonds work and the fact that as the interest rates go up, which they have been moving higher lately, bond prices will go down. And we saw that come into effect in a big way last year. It was actually the worst year that we've ever seen in the bond market. So interest rates have started to increase, but for many years have been at historic lows. When rates rise, bond prices drop. Bond funds are not safe from decline. Remember, as those bond prices go down, then the bond fund prices also will move down. And you can lose money in a bond portfolio. Ask anybody that was in a bond portfolio or had bonds in their portfolio last year, and they can confirm that for you. Market risks. So let's talk about market risk. So when it comes to markets, the popular thing for people to talk about is the return, right? So we like to, share, brag, whatever you might say is the right word, about the return that we've gotten on any particular investment that we've had. And most times we don't think about the risk, right? We don't think about the risk of that investment until the market heads down. But we actually believe that you should focus on reducing risk first and then focus on income, especially as we move into retirement. Focus on risk first and then focus on income. So I understand why most people don't talk about risk. They don't think about risk. It's not sexy. It's not as exciting. There's nothing to brag about like we brag about when we get great returns on our different investments. The average investor is a passive investor, meaning that they buy and hold. The question is, and you've seen this once probably in 2008, you saw this in the COVID market crash. When the market's down 30%, 50%, can you stick with those investments? Especially as you get closer to and move into and through retirement. And the other question is, should you? Are those the types of investments that you should be in, where you're actually seeing your investments move down 30 or 50%? I love this chart because most investors probably don't realize the damage that their investments do when they move down. And this is a good way to look at that. So if we take a look here, let's jump right in the middle of this chart and say, okay, if the market or my investment goes down 30%, how much of a return do I need to get just to get back to zero? So if I'm down 30%, I need to gain the next year of 43% to get back to just zero, to break even. And if I've gone down 50%, that means I'm going to have a return of 100% just to get back to zero. So let's think about that for a minute. So if I've got $100 and it goes down 50%, I'm at $50. And then in order to get back to 100, which is where I started, now I've got to have 100% return on my $50 just to get back to 100, just to get back to where I started. That can be a challenge, and that's why we want to think about risk first, because if we can avoid those big downturns, we don't have to get quite as big of an upturn or positive return on our money just to get back to zero, and then hopefully to have some gains on our investments. So let's look at portfolio diversification and a buy and hold strategy. So a moderate growth portfolio is typically a 60-40 portfolio, meaning about 60% of your allocation is in stocks, 40% is in bonds. And let's take a look at a time period going from 2000 to 2016. Now, you've probably heard about what was called the lost decade. The lost decade was from basically 2000 to 2010. And if you take a look at this chart, you can actually see here, if we started with $100,000 and we went forward to 2010, 10 years, we rode a pretty big roller coaster. And that's in a 60-40 portfolio, right? And at the end of that 10 years, we can see that we're really right back where we started. We've had some big downturns, and going through those downturns, as we all know, can be very difficult. It's very difficult to be able to stick with your investments, to be able to see those big dips in your portfolio, those big dips in your money, and be able to stick with it. But if you did stick with this portfolio, by the end of 2016, your $100,000 had grown to $162,000. So your inflation-adjusted return over that time frame was 3.1%. But that's riding quite a tough roller coaster throughout that time, which makes it very difficult for most investors to do. Here's another example. So you've probably heard of target date funds. If you've got a 401k or some sort of a retirement plan through your employer, these are actually very popular investments within those retirement plans. So basically the way a target date fund works is you pick the date that you're planning to retire. So in this target date fund, you're planning to retire in 2025. And if we look at what this investment has done over the last 5 years, you can see you've had some pretty big dips. Pretty big dips on a fund that gets more conservative as it gets closer to your retirement date, 2025. So my question to you is, how confident would you be, or how would that make you feel, knowing that you're about to retire within the next 2 years? And your portfolio is riding a roller coaster, and you're seeing big dips in the money that you've saved throughout your life that you're planning to need to use as you move into retirement. So how do you measure risk? I told you I'd keep financial jargon to a minimum, but how we measure risk is we look at the standard deviation. Standard deviation is the measurement of volatility in your investments over time. So when we looked at that roller coaster that the last two investments were on, the standard deviation is measuring how big are the dips, how big are the movements up and down in those investments. So let's take a look at an example here. So scenario one, it's a standard investment approach. We've got an average return that's averaging 6.15% and a risk of 13%. So basically what that says is if we look at this chart, you can see the average is 6.15, but on the downside is a probability within that 95% range of being down 6.85%. And there's an upside probability of 19.15. So 95% of your probability is going to fall within that range, but over the long term, average about a 6.15% return. Now let's look at scenario two, what we would call a smart money approach, right? So this one, we're averaging the same return, but the risk, we're going to reduce that risk down to 5.5%. So this is what that looks like. Worst case, we're down at about 0.65%. Best case, 11.65. Average, 6.15%. So you can see a much smaller or better downside to this type of investment that averages the same average return. So you can see this one certainly helps us to be a lot more comfortable. We're not riding as big a roller coaster. We're not seeing as big of dips in this type of investment. And over the long term, we're still getting the same average return. So next, let's talk about some Social Security strategies. Filing for Social Security. So if you haven't yet, it would be a good idea to actually go and figure out exactly where you stand with Social Security. So you can actually go to the Social Security website, log in to the information and get your Social Security numbers so that you understand exactly what that looks like for you. And let's talk about Social Security and really how that works. So there are many, many, many different filing possibilities when we talk about Social Security. But for most people, the earliest benefit that they can file and start receiving their Social Security is at 62. Full retirement age for most people now currently falls between 66 and 67. And your maximum Social Security benefit happens at age 70. So the way it works, you can actually file as early as age 62. And if you're filing at 62, you're actually taking a reduced benefit. So between the ages of 62 and your full retirement age, annually you're getting about a 6% pay raise each year that you postpone and let that Social Security grow until you reach your full retirement age. And then between full retirement age and age 70, you're actually getting on average about an 8% annual raise each year that you postpone taking your Social Security and let that Social Security benefit grow until the maximum age at 70. And then at 70, that benefit stops growing. So at 70, there's no reason to postpone it anytime past that and start taking your Social Security benefit then at age 70. Pop quiz. So if you are married, what happens to Social Security when one spouse passes? The answer is that your small check goes away and the larger one stays. So if you're married and you're both receiving Social Security, one check is smaller, one check is larger. When one of you passes, who doesn't matter which one, the smaller check of those two is actually going to stop being paid, and the surviving spouse will continue to get the larger Social Security check. Next question. So if you take $1,000 from a traditional IRA or $1,000 from Social Security, which one is worth more? The answer is Social Security. And the reason is that 15% of your Social Security is always tax-free. We'll talk a little bit more about that. So, key questions when you're thinking about filing for Social Security are, when should you file? early, on time, or the late benefit at age 70? How long will you work? What age are you going to retire and stop working? Will my or our benefit be taxable? We'll talk a little bit more about that. What will the surviving spouse receive? So very important, when you take your benefit early, if you have the larger benefit, when we talked about how the surviving spouse will get the larger benefit, well, if you're taking it early, remember you're getting a reduced benefit, and that will affect that benefit throughout your lifetime or your spouse's lifetime, whoever lives the longest. Am I sure that I'm filing correctly the first time? What different options and strategies do you have? We talked about there's many different options. And how will this all tie into your retirement plan? So let's talk a little bit about how Social Security is taxed. So it's based on first your modified adjusted gross income. And then they take all your income plus half of your Social Security and then place it in these thresholds. So when we add that all together, if you're a single filer and you make up to $25,000, you're not going to have any tax on your Social Security. But if you make $25,000 to $34,000, your Social Security, 50% of your Social Security will become taxable. And if you make over $34,000 as a single person, 85% of your Social Security becomes taxable. If you're married, it's a little bit larger range. So 0 to $32,000, you won't pay any taxes if combined your income is under $32,000. Combined, if your income is between $32,000 and $44,000, 50% of your Social Security payments will be taxable. And combined, if you make over $44,000 in income, 85% of your Social Security is going to be taxable. So you can get more money from Social Security by creating a more efficient strategy. A personalized Social Security maximization analysis could also help you increase your total benefit over your lifetime. And many times we've seen this be anywhere from tens of thousands to hundreds of thousands of dollars over a lifetime in greater benefit by making sure that you're maximizing that Social Security filing. So let's talk about some income bucket planning. First, let me ask you, have you ever heard about what's called the retirement red zone? If you haven't, the retirement red zone is really the time period of about 5 years prior to retirement all the way through 5 years into retirement. It's the retirement red zone. This is where things can really significantly impact the success that you're going to have in retirement. And that's why, as advisors, we usually recommend that you want to start planning for retirement probably about 10 years prior to retirement so that you can create strategies and do things that are going to help get you in a better position before you move into this retirement red zone. So let's talk about one of the risks in this retirement red zone. It's called the sequence of returns risk. And the way it works is this. So in the accumulation phase, let's look at two different examples. Account A and account B, we started with $500,000. We invested it for 20 years. And over that 20 years, we averaged a 10.4% return. Pretty good return on our portfolio. And in account A, the way that worked out was the first year we got a 33% return, second year -5, third year +32, +6, +12. And all the way down in year 20, we had a -28%. So we took a big hit in that 20th year. But like I said, throughout the 20 years, we averaged 10.4%. And at the end, our $500,000 turned into $2.5 million. Pretty good turnout. And in account B, again, we averaged 10.4% return, but in the first year we had a -28%. Second year was a -3. all the way down until the final year was 33%. Pretty good return in that final year. And if you take a look at these numbers, what you'll see is what we did is we just flipped the numbers. So 33 minus 5, 33 minus 5, 28 minus 3. We just flipped the numbers. So the returns averaged the exact same amount, 10.4%, but we just flipped them upside down. In that accumulation phase, you can see we still ended up with $2.5 million. Pretty good return, pretty good turnout. So let's move over though to our decumulation or our income phase, right? And we'll start with the same $500,000. And through the next 20 years, we're going to average 10.4% return, okay? But we're in retirement, so we're going to need to take out $25,000 a year. And because of inflation, we're going to calculate in a 3% annual increase to meet those expenses growing throughout the next 20 years. So in account A, same thing, just like in account A in the first scenario, plus 33 minus 5. We averaged the 10.4 last year, minus 28%. At the end of our 20 years, our $500,000 has grown to 1.4, almost $1.5 million. And we've been able to take out the income each year throughout that 20 years. So let's look at account B. Same thing as account B in our accumulation phase. We flipped the numbers, averaged a 10.4% return, and in year 20, our $500,000 is now at a negative $75,000. As a matter of fact, we actually ran out of money in year 19. Sequence of return risk. There's many things that we can control in retirement. There's some things that we can't control in retirement. Sequence of return risk is one of those things that we cannot control. We can't control when the market is going to give us certain returns. We can't control the sequence that those returns are going to come in. What we can do though is we can create strategies that are going to help to protect us from sequence of return risk. But we want to start early. We want to get a plan in place before we enter that retirement red zone. Here's another scenario. So we're going to take a look at Steve and Bill. Both retired with $500,000, but Steve retired in 1990. He withdrew $30,000 a year throughout the next 10 years. And that $500,000 at the end of 10 years had grown to $1.2 million. Bill was in the exact same situation, but he retired 10 years later. He retired in 1990 with $500,000, and he withdrew $30,000 a year, just like Steve did. And at the end of 10 years, that $500,000 was down to $156,000. Again, the only difference was Bill retired 10 years later. Same situation, same income, same withdrawal. He just retired at a different time, and you can see the impact that that sequence of returns, those returns had on his retirement. So let's take a look at three different strategies. Strategy number one, this is the most common strategy that we see. It's what we call a one bucket strategy. So we've saved money in our retirement, in our 401k and our IRA throughout our life. We've got everything in this 60-40 portfolio, 60% stocks, 40% bonds, steady growth portfolio. And what we do in retirement is, as we need money, we pull money out of our portfolio. Let's take a look what that looks like. So in this example, John and Jean Smith, they started with $1.1 million in retirement. They need to take out $70,000 for their annual living expenses. And they just pulled the $70,000 out each year from their portfolio. And at the end, they started retirement in 2007. And actually in 2006, and in 2020 or 2020, their portfolio was down to $614,000. So 1.1 million down to 614,000 in 2020. And as you can see, that money's starting to go away. John and Jane might be starting to get a little bit nervous about how long that money is going to last as they move further through retirement. So let's take a look at strategy number 2, which is a multiple bucket strategy. So in this strategy, we set up several different buckets. You've probably seen this from some of the financial professionals out there that are actually pitching this type of a strategy. And the way the strategy works is that you basically divide your money up into 4 buckets. You've got your bucket number 1, which is money you're going to need for the next 5 years. Bucket number 2 for the 5 years after. Bucket number 3 for the next 5 years. And then bucket 4 for the remaining. And you invest those at different risk levels. And as you get closer to those times, you're actually rotating that money through those buckets. Interesting strategy. The challenge is it's very hard to implement. Could work, but it's difficult. And because it's difficult, most people don't stick with it. So let's take a look at strategy 3. Strategy 3 is a 2-bucket strategy. So in this strategy, we're basically going to put our money into 2 different buckets and take a look and see what that looks like. So we've got 60% of our money in our growth bucket, and we've got 40% in our safe bucket. And the way this strategy works is that depending on what's going on in the market, we may pull our $70,000 that we need each year from our growth bucket, or we may pull it from our safe bucket. And we pull it back and forth depending on what's going on in the market each year. And as you can see at the end of that same time frame, in this 2-bucket strategy, we've actually got $895,000. That's a difference of $270,000 from the strategy that we looked at first, where we were just pulling everything out of the one portfolio bucket that we had. So, do you think this is a strategy that might be helpful? It's a $270,000 difference. That's a significant difference. Certainly a strategy that might be possible. But our question is, could we do even better? Could we create a portfolio that even does better than a $270,000 difference? So let's take a look. So this time what we're going to do is we're going to actually, for that growth bucket, we're going to implement the smart money strategy. So when we talked about standard deviations, right, we're not looking at just an investment and looking at the return, but we're also going to look at what's the risk on that investment. What's the risk on that growth bucket? And let's see what that looks like. So same scenario, we started off with the same split. We've got 60% of our portfolio in our growth bucket. We've got 40% in our safe bucket. We're going to pull our $70,000 out each year depending on what's going on in the market. And as you can see at the end of that time frame, we had just over $1.1 million to start with, and now we're at 1.2, almost $1.3 million. So that's a $500,000 difference in just the way we set up the 2 buckets and the strategy that we used, the different strategy that we used in that growth bucket. And with a 2-bucket strategy, you can see that's certainly something that's manageable, something that can be easily implemented and followed. So let's recap what we've talked about. So first thing we want to do, look at risk, not just reward. It's not just about the return. It's also about the risk in the portfolio. We showed you that in the bucket strategies. We need to understand volatility and the sequence of returns. Things that we can't control, sequence of returns, but we can create a strategy that's going to protect us from those sequence of returns. Creating a bucket strategy. We saw how having a bucket strategy can make a significant difference than just having everything in one bucket in a traditional, the way people do it in one portfolio. And then we need to utilize the tools that we have available out there so that we can understand the risk of that growth bucket that we've got, and then test it and monitor it. So let's talk about how do we axe taxes. So, as we all know, with the ever-increasing debt and stimulus payments, it's putting a lot of pressure on the system. There's promises that we owe ourselves, that we need to consider. We know we have obligations. And we'll talk about some strategies and take a look at that equation and see what that looks like. First of all, national debt. And the reason I put this chart up here, it only goes through 2019. But I think what's important is if you look at how the national debt has grown and then how it has really taken off like a rocket. And this doesn't include what we just went through with the COVID situation and how so much money was spent and added to our national debt during that period. You can actually go to the national debt clock that shows, this is a little bit dated, but it's showing the national debt at 31 trillion. If you pull this clock up, it's online right now, you can take a look at it, you can see how quickly that national debt is growing. And the biggest portion in that national debt is going to be Social Security and Medicare. With the baby boomers that are aging, 10,000 baby boomers are turning 65 every day. And because of the obligations we've made to them through Social Security and Medicare, that cost is going to increase, and it is going to become a bigger and bigger part of our national debt. As a matter of fact, estimates are that by 2030, that's going to be 50% of the national debt. So, how are we going to pay for this? One way is print money. We know what that does. Causes inflation. We could claim bankruptcy. That's not a realistic option. We could reduce benefits. We know that's not going to make anyone happy. Matter of fact, it's being thrown around right now and gets thrown around actually quite often because they know something's got to be done. Something's got to be changed. The most likely scenario is probably that they're going to increase taxes. Does anybody disagree? Interesting. Over $28 trillion currently sits in tax-deferred retirement accounts. So where do you think they might be looking at places to get more money to cover that national debt? Let's talk about RMDs, or required minimum distributions. Do you have a strategy currently for how you're going to handle your required minimum distributions? Law was just passed to move that age up to 73. It used to be 70 and a half, then it was 72, and then starting this year, that age went out up to 73. So that means at the age of 73, you'll be required to start removing money from any of your retirement accounts that you have. So your 401k, your IRA, 403bs, any sort of retirement accounts that you have at the age of 73, you're actually going to be required to start removing money. And this is how that works. So if you go to the IRS website, they actually have a table there that lists your age and factors. And based on your age, the factor is what you use to calculate how much money you're going to be required to remove from your retirement account each year. So let's see what that looks like. Eldon, 75 years young. He's got $100,000 in his IRA as of December 31st, 2022. He's got a distribution factor, as that scale we just took a look at, of 24.6. So what that equates to is that $100,000 divided by that factor of 24.6 means that he's required to take $4,065 out of his retirement account this year. And as we saw those factors change each year, that number will actually grow each year. He'll be required to take a larger and larger portion of his money out of his retirement account each year as he gets older. So let's go through a quick example. This is the story of spending more money because of RMDs and Social Security becoming more taxable. So Joe, who is married and a post office worker who retired at age 62, between his Social Security and his pension, he has enough for him to live on and live his comfortable life. During his life, he also saved $616,600 in an IRA account. He didn't need the money to spend, but what he failed to do was create a plan to see what would happen at age 72 when he must start taking his required minimum distributions. So let's take a look at that. So pension was $27,600 per year. He has Social Security, that's $29,400 a year. Now 50% of that is considered taxable, as we went through those examples earlier. So gross income of $42,300. Taxable income after the standard deduction comes to $16,400, which puts him in the 10% tax bracket, and taxes owed are $1,640 for a total net income of $55,360. Follow that. I know there's a lot of numbers there at you, but keep that in mind as we go through this next example. So let's calculate that out, now adding in his required minimum distribution. So his required minimum distribution based on that scale at $616,000 is $22,500 that he's required to take out of his IRA. Pension, $27,600. Social Security, $29,400. Now, because of that, 85% of his Social Security is taxable. Gross income, $75,090 after his standard deduction. His taxable income is $49,100, which puts him now in the higher tax bracket at 12%. Total taxes owed, $5,492. So his total net income at this point, not including his required minimum distribution, is $51,508. That's $3,852 a year more in taxes that he's required to pay because he has to take the money because of his required minimum distribution. Kind of seems backwards, right? Higher taxes, he's paying more taxes now in retirement because he's required to take the money from his retirement account. Talked about taxes going up. What's the chance of that happening? Well, let's take a look. Taxes, the highest tax rate has been as high as 94%. Right now, those taxes are under 40%. So there's certainly a lot of range there, a lot of potential when we talk about the possibility of taxes. And can taxes go higher? They certainly have been higher in the past. So there's always that possibility that we have to keep in mind that taxes may move higher again. So, what do we do? Let's create a plan. Create a plan that's going to help us to get out of harm's way. That's going to look at taxes, and it's going to move taxes based on our agenda, because taxes are going to go up January 1st of 2026. If nothing changes, taxes are going to go up January 1st of 2026. In 2017, taxes were reduced. As you can see here, 2017 tax rates. 10% was the lowest tax bracket, 15, 25, 28, and then the taxes were reduced. Today, they're currently 10%, 12%, 22, 24, 32. As you can see, however, at the end of 2025, those tax brackets move back to the old tax brackets at the end of 2025. So taxes are basically on sale right now. They're at a lower tax rate, but that is going to end in 2 years, less than 2 years. So what's one thing we can do about that? One might be a Roth conversion. Are you familiar with the Roth conversion and what that is and what exactly that means? Let's go through it real quick. So a Roth conversion basically means this. Any money that you've currently got in a tax-deferred account, such as a 401k, an IRA, or 403b, you would pay the taxes, take the money out of that account, pay the taxes now, and move that money into a Roth IRA. The reason we do that is once it's in the Roth IRA, at that point the money grows tax-free And when we take money out of the Roth IRA, we don't pay taxes on it at that point. So that money, from the moment we move it into the Roth IRA, all the way through as it grows, and then as we take withdrawals from the Roth IRA, we no longer pay taxes on that money. So let's take a look at how really our money is divided up. So taxed later, that's our 401ks, our 403bs, our IRAs, a pension. Tax now, bank accounts, real estate, brokerage accounts, or tax never, our Roths, our HSAs, cash value life insurance is another option out there. So this is how our money is taxed, and the different accounts that we can have, or different buckets, I guess, that we look at when we look at the different assets that we have. So if we're wanting to minimize taxes or reduce taxes and possibly get to a zero tax bracket, which might be possible, we want to be moving as many of our assets as we can from our taxable, tax deferred into tax free. And starting as early as possible to create a strategy and plan for doing that makes the possibility of getting to a zero tax bracket possible. So, what are some good ideas during times like this? And what could you be doing? So, looking at risk, not just return, that investment formula we're talking about, running a risk analysis, seeing how your current investment is, or how risky your current investment portfolio is. Using a multiple bucket strategy for income, reposition and rebalance accordingly. Adding inflation into the numbers, accounting for the unexpected. Looking at tax opportunities. Roth conversions are great when the market is down to capture upside potential. Putting plans together, your current scenario, improved scenarios with less risk and tax opportunity. Very important, monitoring. Use the tools that are out there. It's one thing to do the work and put together a great plan and have a great strategy, but it's also important to make sure that you monitor it, because things change. Each day, each week, each month, each year, things are changing. So we want to monitor that plan. Make sure that we're making adjustments when we need to. Make sure that we're identifying opportunities where we need to make adjustments, and identifying those as early as possible so that they're much easier to make those changes and make those adjustments. The longer we wait, the harder it gets. Every day, every week, every month that we wait, those changes can get harder and harder for us to change and implement. So let's go through some case studies. Let's take a look at Bill and Sally. So Bill and Sally want to retire in 6 years. They're going to need $103,000 a year in after-tax to live comfortably the lifestyle that they want in retirement. They have about $670,000 saved in their retirement accounts. They have Social Security, and they're fortunate enough to have a pension for retirement as well. We don't see as many pensions as we used to, but Bill and Sally are fortunate to have a pension. So current risk to reward, this is a hypothetical situation, but let's take a look. Always have to say that to protect the innocent. But in their portfolio, they had an investment portfolio that was getting an average return of 5.1% with a risk level of 11.4. It was diversified in what we would consider a 60-40 portfolio. And we ran a probability analysis to see what's the likelihood that this money will last throughout their life. We got a probability score of 26%. That means there's only a 26% probability that this money will last throughout their life. So certainly not a plan that we would be confident in. So what did we do? We went to look and say, okay, let's see how we can improve this situation. So we looked at a better investment, okay? Investment that's going to get us a 7% return, so a better return. It's going to get us a risk of 10.8, so we're reducing that risk. And we looked at starting Social Security on a different date so that we can maximize that Social Security. The difference was the probability score came to 79%. So as you can see, a much increased by having a better investment portfolio that they were invested in, and then also maximizing that Social Security. So far, what have we learned, right? We don't need a lot of risk. We don't need a really high return, but we do need a good average return with minimal volatility. So let's take a look at that same scenario to see, we wanted to see, could we make this situation even better? So what we did is, for the investment portion, we looked at a smart investment strategy, like we've talked about. So an average return of 6.14, a risk level of 7.5. So we've actually reduced the return that we were getting on the last portfolio, but we've also significantly reduced the risk. Okay? We looked at, obviously, maximizing Social Security and then making sure that we were tax efficient in this portfolio. And we ran a probability analysis, and we were able to get the probability to 99%. So a 99% probability that the money is going to last throughout their lifetime. We started with the same amount of money, the same couple, but we made tweaks to their strategy, tweaks to the investment portfolio, tweaks to when they took Social Security, tweaks to being tax efficient, and we were able to increase their probability all the way from what they were currently doing at 26% all the way to 99%. So, like I said, small tweaks, having a strategy, having a smart strategy, and then monitoring it. So monitoring it is very important. Do you know what your current probability score is? Are you at 26, 79, 99%? That's really the first place you need to start. You need to know today, what is my probability? Am I on the right course? Am I doing the right things that are going to help me to make sure that my money is going to last throughout my retirement? So this is something that we actually help people with every day. We offer a Success for Retirement probability analysis. If you go to our website, you'll see it's $500 for doing the probability analysis. And we offer this because, like I said, it is the first step. You want to know exactly where you are today in the course that you're on to see if you're able to have a successful retirement. However, because you've attended our webinar, we're actually offering you a complimentary retirement analysis. So no cost, no obligation. Like I said, we normally, if you go to our website, you'll see that we charge $500 for this retirement analysis, but we're actually offering it to you today. If you will schedule within the next 14 days, a complimentary retirement analysis where you will know what course you're on. Are you on the right course? Are you doing the right things? Or do you need to make changes? Because if you need to make changes, you want to know that as early as possible. You want to identify that as soon as you can so that you can make the changes and the adjustments that you need. And when I say there's no cost or obligation, what I mean is that once you have that retirement analysis and you know the course that you're on, you can make the adjustments. I've given you the information. I've educated you today on the strategies and the different things that you can do to tweak your plan and tweak your strategy to improve that situation. So you can go out and do this. Take the information that I've shared with you and go out and make those adjustments. If you are not comfortable with doing that or you want some more help doing that, we're certainly happy to help you and we're here to do that. But there's no obligation for you doing the retirement analysis and at least knowing where you are today and knowing the course that you're on. To schedule that appointment, we can actually do it in our office. Our office is located in downtown Orlando, or we can also do it virtually. We would just send out a Google Meet video call with you, and we'll do it face-to-face through a Google video call. Or like I said, we can meet in our office in downtown Orlando and do this analysis with you. So, like I said, within the next 14 days, you'll need to sign up for this retirement analysis so that we can help you as we have new people that go through our classes and want to get the retirement analysis as well. So please sign up for that within the next 14 days, and we'll get the no cost, no obligation retirement analysis for you. I want to thank you for attending, and if you do decide to take us up on the no cost, no obligation complimentary retirement analysis, what we'll do is we'll send you a list of documents that are needed to perform the analysis so that you can get those documents to us and we'll perform that analysis for you. I want to thank you for attending our webinar today and look forward to hopefully seeing you in the future. Thank you.